We think about collaboration being partners. Hopefully that's something we'll attest to with your experience on that. And then,
You guys have an office in Philadelphia now?
it's in Westchester, so there's the base. That's why I didn't mention that. So I deliberately submitted that, but Philly sounds better than Westchester. 51% of our clients are public, so I do want to mention that this is a significantly important part of our business. We remain committed to public funds and service and public funds. That's a good word for Davis. Page 4 just gives you a snapshot of the public funds that we work with. 211 billion assets with public funds. Again, critical part of our business, and again, it's an excellent big one, including the city of Philadelphia. And with that, we touched upon the East Coast presence that we have as a firm, just really pointing to the fact again, we work with a number of plans in Pennsylvania across the East Coast, and we feel that helps us, whether it's the intel managers, whether it's best practices, and so on.
And then just on page 6, as we mentioned, we're 100% employee owned. That sets up to be independent. I think in our business, what you don't do sometimes be as important as what you do. So just as a reminder, our only source of compensation comes from the direct investment consulting we pay to our clients. That means we don't collect any money from top dollars or profit. We don't have investment products or funds. And at the end of the day, we think that's really important from alignment of interest with you all, helping you do your fiduciary duty. You never have to wonder or question why we're recommending a fund or a manager. We only do it because it's in the best interest of our clients, because those are the only individuals that we work with. On 7, I do think it's important that 100% employee ownership is a big part of our alignment and the focus on client service that we have. There's been a lot of acquisitions and activity in our industry. And one of the questions is, how do you make sure to maintain that independence? One of the things we do is add new owners every couple of years. That makes sure that our ownership base continues to diversify. So we're up to 24 owners. Also important for you all, it is a fantastic way for us to attract and retain great people. So once people become owners at Marquette, they tend to stick around for a long time. So you can be confident the folks that you see here today are going to be here 5 or 10 years down the line. We think that's really important for making good long-term investment decisions.
Page 8 just goes back to the team, the resources, the ability for the city of Philadelphia to really tap into our expertise. So we have a number of colleagues on our research team. We have a core consulting team, and really, again, the collaboration that we feel we've had with the city of Philly as well as staff has definitely been very engaging. Whether it's on the traditional side, private market side, we feel that holistic approach has definitely been value added.
So on the private market side, on page 10, and I sort of hit this a little bit already, but again, I do think the way we structure our business allows us to be really good partners in helping clients form private market portfolios and doing things that are custom and tailored to the best interests of their organization. On 11, when we think about that philosophy, I think one of the things we try and be thoughtful about is efficient implementation. So not having 50 different commitments that you're trying to do each year, but having few impactful commitments. And structure things in a way that is both efficient and can be very cost effective. And Haley will talk about this in a minute, but I think one of the things we've really done a nice job working with staff here is come up with some interesting and innovative solutions to be able to lower the fee for private equities. Some of the separate account for investment sidebars we've done, some of the partnerships with those Franklin Park forbearance, I think are good examples of that and generating fee savings in high actual companies.
Aside from Philadelphia, are there any other public pension funds that you act as private asset consultant and general consultant?
Yes. So as an example, I can mention this City of Atlanta is one example, but the quick answer is yes. We definitely consult on both pools of assets. Some public clients. Yes.
Generally, the majority of our clients, both the public realm and across our entire client base, we are both the general and the alternative. On page 12, and maybe speak to just that point a little bit, this looks at the exposure we have across the firm to various private markets asset classes, just kind of driving home that point of this is an area we invest a lot of resources from a people perspective and trying to spend a lot of time from a management diligence perspective. So over 1,800 meetings across various alternative asset classes in 2024. And then within that, on page 13, working with diverse and women-owned firms is definitely something that's been a core competency and a focus of Marquette since our inception, something we've done for a long time. And so what we're showing you here is the amount of exposure we have across our client base and also within our manager due diligence database. I think this is really important on the alternative side because there is not as much good publicly available information about ownership structure when it comes to private markets and alternatives. And that's where the investment we have in our database really helps our team source, find, and do ongoing due diligence on really high quality, diverse managers. And I'll pass it to Kaylee and she'll talk a little bit more about that.
As on page 14, here's some examples of groups who are with either they're on the city utility pipeline, we've allocated to other clients, or we're actively in due diligence with these managers. But it's very important to us, and we have strong prices with diverse managers. And then to our due diligence process. So we do a very selective diligence process. We try to see everything in the market and then be able to pare it down. So our team last year met with almost 2,000 unique managers. Then it resulted in about 35 commitments. So we try to see everything and then do a very selective process in terms of what managers we allocate to.
And going back to, the approach of looking at the entire portfolio, page 16, I think gives us a really good snapshot of, how we've been able to work and partner with the city of Philly. So we have the current allocation, we have the ITS targets, mixed fees presently where we transition to. And as we think about private markets as well as the public markets, we're very mindful, particularly in this environment, particularly with more volatility. We want to be mindful about how we're deploying and diversifying the private markets program. We want to make sure that we're coordinating the re-ups or the underwriting managers and also doing that in tandem with the redistribution of assets going more into fixed income. So this overall holistic approach, we feel has led to a pretty efficient delivery of ideas at the table.
Like a quick comment on the state of the real estate market, and in particular, talk a little bit about our investment in the core open ended and the queue that we're in.
Yes,
Redemption.
absolutely.
Kind of, in retrospect, how do you think about that?
Yeah.
Investment.
Absolutely. So the core real estate market has now come out of its tough cycle. When we first invested in core real estate, it was still going through a golden point or good point of its investment cycle. So for a handful of years, it delivered consistent returns, didn't deliver the income that was needed. But then we went through a situation leading into COVID where the real estate market, particularly as interest rates were poised to go up, the real estate market definitely did see some retreat, particularly on the core open-end side. So other than 2022, 2023, and 2024 were tough years for core open-end real estate. Now, core open-end real estate is really poised for a pretty nice rebound, particularly with the volatility of the traditional markets. And we would say from an asset allocation standpoint, we still continue to look at core open-end real estate as a good anchor within a portfolio. We think that a good diversifier to the core open-end real estate is infrastructure. That's one area that we would continue to have discussions with staff around when we think about diversifying the real assets allocation. And with UBS and the Q definitely continues to liquidate and pay down, but it has taken a couple of years at this point to get the full redemption. We would say that with the status of the real estate market improving, with the expectation that we could potentially see more asset flows in real estate, because with the sell-off in the equity market, when the equity market does so well, all of a sudden other asset classes don't look as attractive. When the equity market is doing what it's doing right now, all of a sudden real estate, real assets look a lot more attractive. So I think the liquidity of real estate does continue to improve. That improved liquidity could lead to more distributions as we think about the forward events.
And the reason I ask about you is because one of the benefits of investing in real estate is the liquidity, the ability to extract the funds and decide to exit the investment. That is shown to be not true, or not as easy as normal.
We agree with that. Absolutely. In an extreme case, like the UBS case where there was a huge amount of redemptions put in at once, the liquidity was not there. And then with interest rates going up, transaction activity going up, it also just added so many headwinds to the asset class. We do see those headwinds abating right now. So even though we can't put a number on the Q, the macro conditions for real estate have improved. about the headwinds that we're facing next month. And now the challenges that we're facing in the equity market are actually tailwinds for asset classes like real estate.
So what do you think about, in the real estate market as relates to affordable housing, going modern housing, Mr. White, and like, where is that? And you think about?
Yeah.
This,
So we definitely think the affordable housing theme makes a lot of sense and is a very credible one. And we think that affordable housing will become more of a focused issue, particularly in this environment with the new administration. The challenge with affordable housing will be making sure that the things that have made the affordable housing market liquid and essentially safe when you think about backstops and guarantees, they don't get, for lack of a better term, doged. We think about things that have been sacred and things that haven't been touched by the federal government are now in the crosshairs of this administration. Just making sure that that's not an extra layer of risk to be concerned about. Think about the underwriting around affordable housing. That's the thesis of the theme. We definitely think affordable housing makes a lot of sense in the portfolio. We are speaking with managers. We are discussing affordable housing on behalf of other clients right now.
so you think it's tangible as it being right now?
It's a good investment thesis. However, one risk that we're uncertain about right now is the federal level, the level of risk in the federal level where you have, whether it's HUD policies, Fannie, Freddie, they have active backstops in terms of guaranteeing affordability, liquidity, certain types of rates that they belong to affordable housing. The concern is there could be a tweet. We wake up one day and what we thought was normal ends up becoming the rug pulled out from under. So that's the one gray area around affordable housing right now.
It's on this side, so something we want to call out is just sort of here with the focus and with the spending time. You can see this is sort of the lowest 5 years of performance for different areas of the market. So we spend a lot of time in buyout, just given that the returns are stable. It's along with private credit. And also one thing I wanted to call out when you're looking at the asset allocation, I think it's important, even becoming more important to keep in mind, for example, the difference between public credit and private credit. So I think keeping the asset allocation in mind, it's important to look to the how you're positioning public equities during deciding the private money allocation. We're seeing that also in venture capital as well. There's sort of with a lot of some companies that may have gone public are staying private, so just being mindful of our small cap exposure.
So on 18 and 19, 18, I think we talked really about kind of our key areas of focus when it comes to the alternative portfolio. So on 19, I just kind of wanted to make a quick comment on pieces. I think obviously manager selection, the asset allocation are really important pieces of getting the program right and maintaining it over time. But I think the thing that's gone really well here is making sure that we hit and then maintain our allocation over time by consistent commitment cases. So on 20, you can see that this is a commitment model that we run for the program, understanding what the overall asset allocation is, understanding how much we can be committed to the different asset classes each year to make sure we hit and then maintain our desired allocation for private markets. And that's something that's been very good and consistent over the last couple of years. And this is particularly in a market that's pretty challenging. We've seen a lot of volatility in public markets. People talk a lot about the denominator effect. They talk a lot about not getting as much cash back from their underlying managers. And yet, if you look at your target allocations to private markets relative to policy, we've been able to maintain them relatively closely. And we think that's been a good sort of true statement of the work we've done working with staff, with making sure we're committing enough, but not too much so that the plan stays on target and on plan over time.
And then on slide 21, this is the city of customized pipeline. So this is where we track. There's a section for new managers, real estate, credit, private equity. Then we track all three up. So it's a way that we've been able to stay organized. And then it leads to on slide 22, being able to efficiently deploy. So we've done a lot of great allocations and everything over the past few years and being able to stay organized with the customized pipeline as well. Then on slide 23, this was mentioned before, but driving down fee income programs is a focus of ours and staff, and we work together to try to drive as many of the fee saving opportunities as we can, whether it be negotiating side per vehicle. The week before the presentation, trying to get an extra 5 basis points off the fee. So these fees are very attractive in private markets, and the standard fee is 2%, and the post give it there.
Really just in the interest of time, we'll end with a thank you. I should have ended with a thank you, but with a thank you, just to say, thank you for, your faith in the Marquette team, the partnership that we have with you. We enjoy the discussion, the presentation, the research of the date, the put towards the board, bring something, that's adding value and relevance to the plan and the program and the investment, framework, that the board has set out for us to follow. So very appreciative of the opportunity, very appreciative to be able to present today, and can we take the questions if there are any?
How long have y'all, I'm new to this board, so how long have y'all had this contract?
For the private market since 2020.
Okay. And then my substantive question is, reflecting on the past 4 years, what was your time?
And that's a great question. We would say that the one thing that we would, I wouldn't say do anything differently, but I would say going forward, one of the things we would like to continue to bring to the table and discuss with staff is on the infrastructure side of things. So I think with the ongoing volatility of the market, I think that continues to strengthen the case for having private infrastructure exposure in the portfolio. So the results and the returns in the portfolio, thankfully over the past 4 years, we'll use 4 or 5 years as an example, we've continued to deliver in line with expectations, which does point to the strategy working well for us. However, with the volatility we're seeing in the marketplace, with the fact that there could be a lot more pain public markets going forward, we do feel that bringing down some of the listed exposure to infrastructure and looking at private infrastructure would be a very prudent course of action. So that's the one thing that we table for further discussion.
In talking about the fees, not fees.
Our fees, so our fee is based off the level of work that we do with the board. It's based off the fact that this has been a longer term relationship, and we recognize that as the program does continue to grow, we may have to revisit fees. But right now, the fee that takes into account the pacing, the amount of meetings that we have with staff, and the fact that to Nat's point, we're very open and architecture business model. So we know when we're sitting down with people, what we have to deliver on, what the cadence of reports are going to be, and they're less smooth and narrow with respect to where our fees are coming from. So the fees are based off the level of work. It's 325 we've come in at, and we consider that to be a fee that fully reflects the level of work that was required for a program of this size.
Chris, you want to set this up with your fee, is that locked in for 4 years or is that
Yes, it would be.
staying?
Correct.
But you said, but do you consider that amount to be within the industry standard?
For an independent
The low
firm,
end of the high, yeah.
so I would say that there are firms that definitely charge more, but they charge more because again, I feel that their models are not independent. There are other revenue sources and other things at play, but us as a pure play consultant, it's definitely a fee that's in line with the work that's being done and the transparency that we're bringing.
Clayton Tara, they asked me this earlier, just from Cat Judge. So the new city rules contract 5 years. Yeah. If that's the case, we could remain the same.
Yes.
But the RFP was put out with that rule, was in existence.
Right, 1 year, right, initial contract, not a multi-year contract, right, so. Initial, I recommended for.
Yeah.
Yeah. The RFP predated that. So that's not just.
Definitely, yeah. Thank you.
Thank you all very much. Appreciate it.
Keep wearing.
We're gonna put that contract.
I was encouraged to.
Chris, are you doing, I don't, you fill out that next to you and putting agenda items to approve?
We're gonna be bored. Yeah. But can we say that, I would like to make a motion that we take the vote for this part until next month? Is that, because the action is the action item, correct? So, yeah.
Moved and properly seconded. No objections? Hearing none, motion passed.
Learned all of this.
I know.
Now you have to do it.
Although you know what's new.
Oh, this is the test.
Somebody's waiting for your. Welcome back.
Thank you. Nice to be back.
Yes.
No, this is a public.
In the interest of time, I'll go through the numbers briefly. If there's questions and such, we're happy to hit on that. Did receive the estimated month-to-date numbers through Tuesday, was went out yesterday, but in terms of the formal numbers, for March, down 1.5%, 10 basis points below policy benchmark. We see longer term, consistent, pretty consistent outperformance for in line with 5 years. And if you look at the longer term, the 7 and 10 gap between the two is really continued to narrow. Things that we're keeping and a pretty close eye on, some of which were actually went on this morning, as the meeting was starting, which were numbers that came out. Markets are up today. I'm not gonna pretend to completely understand why. It seems to be that the market believes that there's now some sort of what's being called a Trump put on the market, that he's kind of reached this pain tolerance with part of the market's going down. Again, that's a theory. There also seems to be perhaps a softening or changing of the tariff policy. He denied today that as the meeting was going on, he denied that there was not trade talks going on with China. We're saying not, he's saying there are. We've also, foreign policy, we've gone from, I think, yesterday, and taking it from leave it to go to Ukraine to today, the tweet telling the Russia will stop bombing. Again, it's very, that makes the markets very volatile. I know that we don't market, something we try not to. We and I talk about it a fair amount, and others, people on staff, this really does feel at like compared to, the COVID market, other markets that you're involved with. Something else that just happened within, companies, again, they're clearly showing concern with the cloudy economic outlook. Just today, American Airlines, their stock is down today despite the first quarter expectations. That's because they formally withdrew their next year guidance because they just don't feel comfortable with what's going on. So despite outperforming the stock down, we see a slowing housing market, which I know some of the folks who are going to talk about. Jobless claim applications came in line with forecasts, 2,000 forecasts. And then this one surprised me a little bit. The Fed president today, the Fed president actually had a somewhat, a positive outlook on the possibility of bringing cuts by June. That threw me a little bit, just given from some of the other regional chairs as well as Chairman Powell. The market seemed to be reacting a little bit favorably to that. So again, a lot going on. I think the portfolio, I think the managers by and large have held up, pretty well. There's a couple that we're talking to, maybe, fear just about their 1 year fiscal year to date number. But most of the managers, I think by and large, have held up well. We do have the low volatility, RFP is out. I think the numbers there continue to strengthen the case for perhaps considering at least a partial tax option on those managers for the sponsors will in. Real estate was a topic today. I know interestingly, it's only one data point, but if you look at page 27, both UBS and Clarion were positive for the future and both outperformed modestly. Honest, as we would say, if that, whether or not that represents any sort of, activity, I'm not ready to say that, but I just, everything is interesting now. We've seen, seen previously. And then we did just want to very briefly just talk about the RRP. We did make the investments that the board approved and reviewed on April 1st. The next tranche of those, which is scheduled for May, that would represent 10 million additional dollars to Garcia Hamilton, 10 million additional dollars to Runway for bond, 30 million to 30 million additional to both Lutheran Circle and Longfellow, and another 20 million to Brandon. Again, right now, we don't believe there should be any change to that strategy. But again, we are in a market where I could come back to and say, we think we should wait, or we think we should tweak it. Right now, we continue to be comfortable with that. And then we, probably at the May meeting, and talk about where we continue to invest the $1 billion in cash.
But this is all fixed.
Yeah.
We really want to put up the last 3 weeks. We don't think the diminished equity values are an opportunity at this point. Still too much.
I think so. I still think there's a little bit too much uncertainty. We also are slightly overweight US equities. Yeah, so we are slightly overweight US equities. I think, I would be comfortable making a raw call of bet, for lack of a better word, on any equities at this point.
Yeah, we're in line with that. The fact that it's a clear rebalance in the fixed income is something that we're very comfortable with, just given the market. Even though the market's rallying right now, to Chris's point, trade has some it doesn't make sense. Treasuries, your T-bills and your securities trading at higher yields at a point where the yield should be coming down. That in itself, along with the economic use, that any type of economic use that's not good with the tariffs could lead to more of a sell-off. So we'd rather err on the side of let's continue to rebalance into fixed income when we're underweight. Technically, we're not underweight because we have cash being used as a proxy. But let's think about market duration fixed income. Let's continue to rebalance into that. And let's continue to see how things play out in the equity market. And if we are going to rebalance at any point into equities, it would be your quality, your value, your managers that are tilting away from the high momentum names that are just seeing these radical ups and downs.
I think that we've seen, not that it's incident, we've seen treasuries recognize things happen. Private equity, I hope it goes as that.
Yeah, I mean, I would say it's going to be mixed in terms of the overall exposure. Depends on the manager, depends on the businesses that they're underwriting, depends on whether they're importing, exporting as part of that business model. The one thing we can say with certainty is with the tariffs and the market selling off, rebounding, selling off, thank goodness the private equity markets are not absorbing that noise, because a lot of the noise is just based off sentiment as opposed to the reality of what's going to happen with tariffs. As and when it's figured out, and God knows when that's going to be, but as and when we know what tariff policy will look like going forward, I think we can have a clearer sense of, okay, well, this manages part of the supply chain in terms of what they underwrite the businesses that they're in. We expect X, Y, and Z to be full out tariffs. But right now, I think it's more positive than negative when we think about the fact that these are not talked to market on a daily basis. And a lot of the headlines, a lot of the noise on any given day, where, for example, it's Zelensky taking a leave at something it's like, don't want Ukraine, that type of framework where the market's going up, going down based on tweets. Private equity is not absorbing that. The longer term, we'll be in a stronger position to figure out what tariffs will mean in terms of costs, whether it's unit costs or even loss of revenue on some of these companies in the goal products that we're in.
And we have heard from certain through some questions time to Franklin Park actually reached out to us with that. Earlier this week, we have a call with them, I think on Tuesday, where Brad was in his team to kind of go through line by line, company by company, the ones that are really exposed potentially to tariffs or kind of like a yellow make or the ones where it's just like a clear signal. So that it's definitely something we're going to managers about. And it's clear a lot of it. Thank you. Yep. No other investment performance questions. Just wrap up with the securities lending, 107,120 for the month, 55.77 program. Diverse and local AUM down, came down, and there's a reason for that. If you actually look back at the same time last year, March of 2024, that's the thing happened. We obviously got all the cash in, which meant we had a larger amount of assets sitting in cash, meaning no money was really moving around that much. There's more of the total. We also did do a little bit of rebalancing online at the beginning of March. That's really at the mix. It's really just the total amount of assets. As you can see from March of last year, it just continued to steadily climb back. So just under 50% diverse assets for the end of March and 9.25% surrounding counties. Lastly, the upcoming board meeting is May 22nd, June 26th, and July 20th.
Can I just ask, you talked a little bit about the issue of tariffs, but a lot of banks and investment firms are increasing their odds of a recession in the near future. What does that look like in the broader scheme rather than just looking at the impact of tariffs?
So again, it's going to be industry sector specific. I think you saw a little bit of it. We touched a little bit on it for report. For the growth index to be down 10% in a quarter, Russell value be up 1.6%. I don't remember the last time there was I remember the last time there was divergence, but that magnitude would have always been the other way. So I think you're seeing a real concern about that, a real retrenchment. Look, the first quarter numbers have all still looked pretty good. The holiday spending numbers that have come in look really good. But I think a lot's really going to depend on what happens in the next, really honestly, 30 to 90 days. Because once the consumer starts to hunker down, it's going to take a while for them to feel comfortable and start spending again. The amount of uncertainty that's out there, when inflation's still at least potentially ticking up slightly. But there's a lot to still figure out. But to your point, the odds of recession certainly increase. Depending on who you talk to, some people say I'm not.
There's an interesting anecdote. My 15-year-old son is rather than coming to New York for money, he's going on eBay and selling his clothes that he's thrown out of.
Oh, right.
He's reading about the economy slowing down, things becoming expensive, so when a 15-year-old is changing that behavior, it gives you a sense of, maybe that's something on the horizon.
Yeah.
So you said that the unemployment, rates or the job losses, in your projection. Was it under the projection or
It
was
was just, it was 222,000 to 200.
was that, the projection, was that much higher than previous months? I don't- this was certainly-
I think her mom was like, projection. So, so now it's. But again, we still haven't seen the full, our citizens, our means, but we still haven't seen the full impact of the federal job.
I agree. That's what we have to see. Yes,
University.
I agree.
Layoffs or job cuts, all that. That's in flux too, because courts are pausing or stopping them. And so you don't know, is it gonna be permanent? Is it even gonna happen? It's announced, and then if the court blocks it or there's the administration walks it back, maybe that doesn't happen. So again, I think that's why I said earlier, I don't like to throw those words around unprecedented from managers, CNBC, but this really does feel
Yes.
different than, what we went through with COVID or financial crisis.
But we weren't there. Oh, 2009 we were there. I mean, even prior to that, our parents' parents.
Oh,
Yeah. That's what I'm talking about.
Yeah, no.
No, because this is what that could be.
Yes, being taken off.
Yeah.
The gold standard.
Yes. Yeah.
Yes, that's one of the.
Yeah.
That happens in.
I know, I mean, right?
See, this is what I said.
Yes, exactly.
She did say that.
Well, exactly. Okay, motion to adjourn?
Motion.
Yeah, exactly.
Any denial, any denial? No. We all have issues. Any objections? Hearing none. Carrying.
Thank you.
Okay, so I have, but it is, sorry guys, I have to do a motion to accept the full actions of the board. Okay, motion, for the full board to accept the actions of the investment committee. Moved, second, properly moved and seconded, any objections? Motion. We are adjourned. Okay. Thank you.
George, you have a study.
Great.